sides to a really great financial future. Tom and Don are talking real money.
Oh, I hate clickbait. I hate clickbait. And yet, I still read the stupid stuff. I do. It sucks me in because I go, come on, give me a break. What am I talking about? Well, we'll tell you in a minute because first I have to tell you what you're listening to, even though, it's funny. It's not like radio. When you listen to a podcast, you've pretty much already chosen the show you're going to listen to. So I don't even know why we do an introduction. Really, we don't have to say this is Talking Real Money because you see it on your screen on your device. Oh, I'm listening to Talking Real Money. Yes, you are. I'm Don. You probably knew that too. That's Tom. Unless you're a first-time listener, you probably didn't know that. He, of course, hangs out in the Model Military Aircraft Museum.
Which is growing daily. I'm struggling a bit.
Yeah, but it's smaller than it used to be.
Yeah, that's true. So the room is not growing, but the number of planes. I'm trying to finish the HE. Oh, that's right. We got criticized for mentioning it. So
yeah, we can't.
HE-177. Trying to get it done. It's a big project.
Dude's obsessed with trees and World War II aircraft, really. Mainly World War II
Well, what about soccer? We're just the World Cup
and soccer.
Okay, there you go. Now you got it covered.
Do you have anything else you're interested? No, nothing
that's
really.
That's about it. So
yeah, that's about it. Welcome to the show. Don here, Tom there. Thank you for being there, wherever the heck you are, doing your dog walk or your car drive or whatever it is you're doing. What do you think of articles like this? Here's a headline from a recent article from the goofy, it's lost its mojo, it's really over and they don't know it yet, Kiplinger personal finance thing.
Which is too bad because it used to be a really great publication.
Yeah, but they lost their touch.
I think they lost their soul, actually.
Yeah.
If you gotta
be honest. Not just them. Money Magazine lost its soul.
Right.
Barron's had always lost its soul.
They were always evil.
They were always evil. Weird. Here's the headline. You're gonna hear this and you're gonna go, oh, I gotta know what those are. The 5 top buy and hold investments to manage market volatility from Jeff Reeves, a journalist in air quotes, financial journalist. His bio is hysterical because it really does. It says nothing. It's a bio that says really absolutely nothing. Jeff Reeves writes about equity markets and exchange traded funds. A veteran journalist with extensive capital markets experience. Jeff has written about Wall Street since 2008.
Capital markets experience if you're an investor.
Yeah.
Covered.
His work has appeared in respected outlets including CNBC, Fox Business, Wall Street Journal, Digital Network, which it's different from the Wall Street Journal, by the way, USA Today, and CNN Money. That just means that there's some sort of a, here, write us 500 words, we'll give you $1 a word or something.
Yeah, but let's listen to this open. It's powerful. It really reaches in and grabs you because it's so unusual. Market volatility, he writes, is the norm in 2026 with political uncertainty and inflationary pressures defining price moves in the first half of the year.
Okay, that paragraph, you could substitute any year for 2026, and that paragraph would be just as applicable no matter how far back or forward you go. I could say market volatility will be the norm in 2027. With political uncertainty and inflationary pressures defining price moves. I could say that.
Yes, you could. But could you say the following? Where actually I kind of agree with him here. History shows that long-term wealth is not built by reacting to these short-term headlines. Rather, it's built by maintaining disciplined exposure to high-quality assets that grow your nest egg over time.
And that is where the article should have ended.
The logic is
right
concluded
there, because everything that follows, well, not everything that follows, because he does say, if you're picking assets based on predictions, that's a mistake. So you need to do a mix of stocks and exchange traded funds. So we've got 3 paragraphs that kind of work. And then he gets to his 5 recommendations. And by the way, this dude loves numbers. I looked up some of his other articles, and they are voluminous.
So if he's only getting $1 a word, he's probably okay then if he's writing a lot.
Here are some of his recent articles. 10 can't-miss dividend growth stocks to buy. 7 consumer ETFs to play the next big tax return spending spree. 5 lesser-known energy ETFs to play oil. Best ETFs for 2018. Best gold ETFs and precious metals ETFs. And they all have a number in the title. All of them. By the way, this is a debunked belief that numbers in titles help attract readers.
I thought that was Paul Merriman's thing too. That's why
it was based on an article. It was based on an article Paul read about attention spans, and that human beings didn't have that goldfish had longer attention spans than we did. It turned out it was a debunked article. There's been massive amounts of academic research done into headlines. They actually research headlines.
There's 3 studies that were done.
Yeah, and they found that putting numbers in makes no difference.
Oh, okay. I always thought it was a rule of 3 anyway, but okay. 10, fine, whatever, 15.
So what are his suggestions, Tom, for stability in a volatile market?
First of all, any stock or stock fund is not bought for stability.
No, but he says low volatility.
Yeah, well, okay. Number 1, and this is a shocker, frankly, because it's probably a fund you've never heard of, even though it just passed $1 trillion under management. First ETF to do that. That would be VOO, the Vanguard S&P 500.
Or as I call it, voodoo.
Voodoo. It's inexpensive. It has a great 10-year return.
It's the S&P 500.
Thank you. Yeah, it's really not that
exciting. It's
exciting.
500 stocks. And, like a third of it is just a few big companies.
Yeah, a third is, I think, 10 or maybe 11 companies total.
Yeah.
And that'll get worse now with, although I just read, I think I read this correctly today, the S&P 500 is now, the S&P has decided not to add SpaceX for a year to the S&P 500.
Good, they didn't pander.
Good. Yeah, that's good.
But here's the thing.
Yeah,
so his first, he comes out with a domestic equity fund, which I'm okay with that in concept. That's a good place to start. But it should have been VT or something similar, something broader, because he goes with a broader index for his next choice.
Yeah, VXUS, the Vanguard Total International ETF. So here you're getting 88 companies. With the S&P 500, you're only getting 500 in the United States. It's kind of an odd offset.
88, not 8,800.
Says 8,800, VXUS.
You said 88.
Oh, 88. Well, my mind's stuck on 88. 8800. Thank you for correcting me.
See, that's a lot of stocks. That makes more sense to me.
It does. And by the way, when you do invest in there, 15% of the money goes to Japan, which I did not know, and UK and Canada get about 8% each, which is more than I would have thought. So, but at any rate, that's a well-diversified fund. Again, it's inexpensive, and you basically get most of the international market buying those companies that way.
By the way, to me, that is the only good suggestion he makes in the whole article. I don't think the rest of them are any good. But go ahead. Tell us the rest.
Next one is the XLV Healthcare Select Sector Spider Fund. This is tied to it's going to surprise you, the healthcare sector in the United States. 60 healthcare stocks. Big Pharma, of course, Eli Lilly, Johnson & Johnson, et cetera. 10-year return is outstanding. Pardon me, not 10-year return.
No, wait.
I'm looking at the next one.
I was going to say, no.
Not very good. In fact, I just looked that fund up, and it was not very impressive. But you're getting exposure to the sector that it has to be great, Don, into the future, because we all need healthcare, right?
It doesn't have to be great in the future. And I got to tell you, and just because you mentioned the performance, I went and looked because I wanted to see just how bad it was. And at 10 years, it looks pretty good. But if you look at VT, the Vanguard Total World Index, it did 13% over the period when this one did.
And you had lower cost.
9.5%.
Lower standard deviation. So anyway, it doesn't make sense. But the next choice, really, you got to wonder.
This one bothered you.
How? Because this apparently came from the Department of Redundancy Department. Now, remember, in the S&P 500, you own about...
Wait a minute. Isn't it the Redundant Department of Redundancy Department?
Whatever it is. They're redundantly passing out. Here's the thing. With the S&P 500, you have about almost 7% of your money in Apple stock. Pretty significant allocation to one company, frankly.
Although if I look around me, I have, I think
that's true. You are
the bulk
Mr.
of my
Apple.
studio is Apple
That's
technology.
true. So you are the spokesman for Apple, but he recommends Apple stock.
That's one of the 5.
That's one of the 5. Crazy.
And I think he's only doing it because the 10-year average annual return was 30%. That's got to be the only reason. It doesn't sound like stability with a 30% 10-year average annual return.
But it has unmatched brand loyalty.
Well, I can attest to that.
And it has a huge amount of cash on its balance sheet.
Okay, fine.
And he says it seems to be one of the best stocks to buy for the long run.
Until something else usurps its position?
Exactly.
I mean, that's the way business works. That's why we don't bet on individual companies, because it's not the individual companies individually that make the market a good place to invest long term. It's the economy. It's the sum of all of these individual companies, because one rises and one falls, and we see it over and over again. Over and over again. But I mean, 50 years ago, IBM was the Apple of the world, was the apple of our eye.
Exactly.
And it ain't no more. Apple's the apple of our eye.
But did you say 30% a year for the last 10 years?
Yes.
Yeah. That alone would make me nervous, because that's a pretty steep hill they're climbing there. Can you keep
Plus,
going
they've lost
that fast?
their very, very, very successful CEO is being replaced. And while John Turnus could be a great one, we don't know. We don't know.
Have they gotten into the space market yet? That's what.
No, they're not. They're not going the Bezos, Musk,
no rockets.
Who has the bigger rocket race?
We're not talking about that on this show.
Well, no, they're going the new Glenn versus the. Never mind. I'm just
Zuckerberg's.
They're all blowing up.
His big boat just showed up in Seattle. Boat, can even call it 347-foot boat. Somebody's asking me what it would look like on our lake. I said it'd fill it.
Totally from one end to the other.
Couldn't turn around. Okay, if that was a bit troubling, how about
we're still waiting for number 5, Tom.
Yeah, how about something that's a little more shiny and a little more exciting because it's had a great run, especially over the last year and a half? That would be iShares Gold Trust. Talk about buying something after a great. I mean, gold has done very well recently, not as well this year. And he admits commodities don't have any fundamentals, but what they bring is a real-world value that cannot be disputed.
I
don't know what that means. I don't know what that, because gold is only worth as much as the next guy says it's worth.
Right, and the other thing about gold is I've got 2,000 years of history on gold. It's the only asset that I can really pull up 2,000 years of history, what it's been worth. And what gold was worth 2,000 years ago is almost exactly what gold is worth today. And here's the other thing about gold. This article is all about stability, right? Right? Wasn't that in the headline?
There was a mention of stability, yes.
Yeah, he said these are investments to manage market volatility. Well, let's look back. In 2021, gold lost 4%. In 2022, gold lost 0.5%. Then in 2025, gold gained 64%.
Yeah.
That does not sound like managing volatility. That sounds like enhancing volatility to me.
I think you're right, and I think this is a very silly portfolio, frankly. I don't know. It doesn't feel like there's anything other than rando picks. And I got to say, if the academics were to look at this, they would just there'd be a lot of red ink. Like what?
I think
no.
I really, when I read this, I wasn't sure if we were going to talk about it or not. And then I went, yeah, it's that clickbait thing. We should talk about it because there's lots of it out there. And the reason I chose this was because at first glance, to me, it seemed totally random. It didn't seem well thought out, and it seemed to come from someone who really did not have any background in financial planning or investment research, although he claims the contrary.
Yeah, he does. Been around capital markets for a long time.
Okay, been around them.
Leaving that portfolio aside, which I think we should.
I have hung out in Apple stores.
I think it should be.
Does that make me a computer expert?
Pretty much. But here's the question. at hand. It comes up. People ask me on a regular basis, okay, this is from Kiplinger. They've jumped the shark. They're not who they used to be. And we have history with Knight Kiplinger, all that kind of stuff. And I like him. But the publication is not, again, a great place to go look for really good advice. But where is then?
Yeah.
Who do you trust? Can you trust, for example, the Wall Street Journal?
Sometimes.
That's the tricky part, right? There's some very good stuff there. Jason Zweig is good.
Not very often.
No.
Market Watch, rarely.
What about information from fund families like Vanguard or DFA?
I think
or
you can
Avantis?
trust because once again, consider the source. Vanguard has been known for very good academically vetted papers and information. Dimensional, all the information that Dimensional puts out is really well vetted and tremendously researched.
And it's not pornography, right? It's not meant to excite.
No, as a matter of fact, it's meant to do exactly the opposite. If you read Dimensional's papers, you'll go, wait, I think I need to read that again, because they're definitely not written at these clickbait articles are actually. I did a lot of research on this. The advice is to write them at a third grade level.
They accomplished it here.
Yeah. I mean, no, that's really what, and I got to tell you, there's no way a third grader is going to get most of what Dimensional talks about.
No, I think that's fair. Okay, but let's set that aside for just a moment then, too. But let me ask you this question then, because at the end of the day, why would you be reading this article? The reason you'd be reading this article, and most people will admit it if you really press them, is the portfolio I'm in, I'm not sure it's the right one because it hasn't made enough money in the last 15, 20 years or 5 years or 1 year, whatever it is, and I may need to change.
Mm-hmm. Well,
That's
and also
reason.
the fact that people have been lately a little bit more scared than usual. We're always a little scared about something. And so they're looking around and they see that volatility portion of the headline and they think, oh, great, 5 easy investments. I can just buy them and hold on to them and my volatility will go down. And the funny thing is this the opposite is true of most of this portfolio. There's very little stability in these ETFs. They're not built to be stable. There's not a bond fund here.
No, nothing going to hold value in a really bad time in any way. Well,
no reduction of volatility.
Yeah.
I mean, incredible. We already said Apple at 30% a year, gold at 60+% in 1 year after following a couple of years of negative returns. The S&P 500, which is not the market, it is a portion of the market. And then healthcare. There's nothing low volatility about most of this.
It feels like a dartboard. Like sort of throwing, I hit that. Oh,
and that may
Apple.
be.
I'll do that, sure.
That may be. Maybe he has a template and he just fills in the blanks.
So going back to the question I just asked, how do you then decide? Because if you're out looking, how do you decide on what would be a better portfolio? If I'm trying to find a better portfolio, how would you do it?
I wish it was easy. All I can say is please listen to us. I'm serious. You don't ever need to become our client or anything, but please listen to us. Because what we're talking about is truly based on lots and lots of research. Now, is it always right? No. We've never claimed to be always right, but at least we don't pander, and our shows don't have any clickbait in them.
No. I tell you what it does have.
We're not
questions.
trying to titillate. What does it do?
Questions.
Yeah, no, and by the way, when you do questions, you can send them in. You 2 ways to do it. You go to talkingrealmoney.com and you speak them. I'll do them on the Friday podcast, and I need a couple of those. Or you can type them, and then Tom will occasionally call you and have a conversation with you, or he'll read them.
Do you want to go with the reading? Is that what you're saying?
I saw you had them ready.
Okay,
Hold on, let's not do that. Let's go to. I've got it because I've got your caller.
Okay. I wasn't sure.
I'm going to do this all over again. And Tom can either read them from his pieces of paper, which he loves to do, but what he likes even more is to have a conversation with you.
We're going to go across Puget Sound to Bremerton, Washington, where we are going to chat with Brian. Brian, thank you for being part of Talking Real Money. How can we help you today?
Well, thanks for speaking with me. I enjoyed listening to the show. Just listen a lot to what you guys would say. You talk so much about different strategies, and I had perhaps a little bit of a unique, although you've kind of touched on this before, but given I've got a little bit of a unique time horizon, I wanted to see how best to approach it, see what your thought was. So I've got, a very charitable mother-in-law who was wanting to gift a chunk of her estate to my sons, her grandsons, as part of her estate plan. And so my wife and I will become trustees, a spendthrift trust for each of them. And so the trusts are to terminate by design in about 12 years when each of them turn 35, and specifically the intent or the trust, and therefore our fiduciary responsibilities to use the money now as we see fit for their support and maintenance and education and so forth. And so I kind of struck with, okay, how do I, approach this, and how do I invest it in a fiduciarily responsible manner, knowing that there are kind of two goals. One is to anticipate an unrealized need that may come up for school, or perhaps, as they're in their young 20s and, in their late 20s, early 30s, getting married and wanting to buy a house. So that'd be a substantial withdrawal. And then the other one is that, okay, it terminates it in 12 years, and it's not quite the same as retirement, like for a target date or heading off to college, like at 529, but there's still that thought that it's got this dual objective for investing. So you invest for now and keep it stable, or do you invest for the future, or what is the right hybrid? So as I think about what would be the bucket approach, if I was to apply that kind of strategy. So I was kind of thinking what you all would think about that.
Yeah. Well, first, I think, does your mother-in-law need any more friends? Because, I'm always looking for a couple friends, and
Right.
$500,000 goes a long way. I think this is amazing. I think it's awesome. Makes me feel guilty about my grandkids, so I hope they're not listening. So this is really great. So, $500,000, and that could have substantial growth in 12 years, right? I mean, you could get a double in that time. It could be $1 million you're handing somebody at 35. What an advantage that would be. So,
Exactly.
yeah, your question is kind of, so with that in mind, how should that be invested? And the trust will be paying out something the next few years, is what you're saying. You're sort of standing between the kids and the money, basically, as trustee, to say, yes, the trust will pay this, or no, it will not. Correct?
Correct. And my thought is, either both listening to you all and some other education I've done with myself, is that to, not, as you all would say, not to let the tax tail wag the dog. I intend to distribute some or most, or if not all, the income. I want to invest it, in ETFs on the equity side, so that, whatever that may be, so that, we keep the taxable income on the trust down, distribute dividends and whatnot to keep the taxes down, but still, anticipating substantial growth in whatever equities I would invest in.
Yeah.
And so, but there still may be a need if they need a new car, or if they're going off to graduate school or something, that we would make larger distributions.
Yeah. So those things will come up, and you'll need to create the cash for that. So that gets back to kind of the big picture, so how much should be in something that doesn't have much volatility, like fixed income,
right?
And how much is for growth?
It strikes me a little bit as someone would approach it when they're in retirement, but I didn't know if that was the right way of thinking about it. And then, because so if you think about it that way, is it more like a traditional 60-40 split, or it's an interesting concept or interesting idea.
Yeah, it's a bit of a conundrum, but here's the way so if it's $500,000, my take would be that if 100,000 of that was in fixed income, that would probably be enough to pay out anything that, let's say, a car or a house or something like that in the next 10 years or so, because you said it's 12 years. So that would be set aside that way. Then the rest of it would be aggressive, because you want that to grow. Man, when you're 22, you're just hoping for, great markets, for that period of time. And by the way, it doesn't end at 35. You hope at 35 they don't pull it all out and, go to Las Vegas or something either.
Well, that's the spendthrift part while they're in their 20s, but
It's good. Yeah. So I probably would be pretty aggressive with that. Maybe 80. I don't love a target date fund in this circumstance, because the asset allocation is somewhat limited. I don't know that you need to go on a glide path really per se, because if you're going to create a little bit of income off of it and pay that out, maybe pay out the dividends, that kind of thing, there's a little bit of fun money there for them in their 20s. You want to have people want to have a little fun. But if you had, 20% of it, as I say, in fixed income, like a BND, and then you had 80% of it if you wanted to keep it really simple, like an AVGE or DFAW, the global funds from Avantis or from Dimensional, that would give you the growth side. You'd hope for that would be 10, 11% a year. The fixed income, not going to make much, but it's the balance and it's the money that's there if something were to come up. And you certainly hope not many things would in your 20s, but they do, right? I mean, your life changes a lot in your 20s. So that would give you the balance. I'd probably want to be that aggressive, though, unless I really knew my kids well and said, look, they're going to need X for a wedding or they're going to need blank for a car or a house. Then maybe you could shade that a little bit more and go, 75% stock, 25% bond. But I really think like an 80-20, keep it simple. If you want a one fund stock solution, one fund bond solution, and you're kind of all set for the short and the longer term.
Okay. That's kind of what I was thinking too, but there's just good to get a second opinion, I guess.
Yeah, no, and I think this, wow, what a wonderful, wonderful gift for a young person too, to get them going at that age. I mean, the only other thing here that I'd love to see is some sort of regular financing of their, tax-free interest. For example, Roth IRAs. I mean, if you're taking a little bit of that out, plug it into a Roth IRA for each one of them over time, that I think would be what a huge advantage if they could fully fund that for the next 10 years, because then even if they did nothing after that, you're probably looking at millionaires there as well.
Well, yeah, thankfully she's already started that. This is phase 2 of estate planning. So that already started last year with those annual gifts. And then that's what, or most of it went straight into Roth IRAs that they each opened last year. So
I love it. This is really great stuff. Man, I think I think your thinking is good here. Diversify, have some in fixed income, hope for great growth and hope for great markets during that period of time. And what a great future for them. Super idea.
Okay, well, good. Thanks for that information.
Thank you for being part of the show. Appreciate you listening and hope we get to chat again sometime.
All right, you have a great day.
Thanks, Brian.
And see, wasn't that a lovely conversation?
I enjoyed it very much.
Yeah, see,
really
he enjoyed it. But he still likes reading the questions to me, particularly ones that I have not heard before. So he thinks he's going to stump me.
That's fair. And this one comes from Jay Mo in Seoul, South Korea.
Okay.
Now I'm going to read this.
Wow. From Seoul? Wait, from South Korea?
Yeah, I'm going to read this in the original Korean, so you may need to translate a little bit.
I need ChatGPT. Hold on.
Yeah, something. No, I'm not. Gentlemen, you are the last vestige of trustable call-in financial advice that I can reliably and entertainingly listen to. As you move into your new, more produced and procured call format, please take care to not become a clone of the now useless podcasts such as Jill on Money, where neurotic, delusional multimillionaires call in to humble brag about their financial situations as if they have any real problems. Your show can't I did not write this. Your show, I'm not this creative. Your show can't devolve into a constant, can I retire? How am I doing format? Please stay topic focused as you already are. Stay golden. Listeners all around the world are counting on you. I've called in before, and you have great advice about an actual problem I was having.
Okay, one. It's not highly produced.
No, it's not.
What you hear generally,
it may sound it, but
unless there's a big glaring boo-boo on our parts, and that's a scientific term for mess up. Yeah. Mistake. Then it just go what we do is what you hear.
What you hear.
I don't, I've had advice from some in the industry who supposedly know more about what they're doing for me to clean up all the ums and ahs and pauses
which
and
are easy to do
stumbles
today,
but you know what? No. That gives a show its personality.
If you do that, it'll be about a 45-second podcast too.
Right.
Really
and that's the other thing. It'd be so darn short if we just did the topic and no asides, no rambling.
Yeah.
So
no, it wouldn't be. All right, you want a real question now?
No, I'm sorry. That was too much fun. I don't want any more.
That was a great question. Thank you. Or comment. Steve from Henderson, Nevada, a little closer to home. Financial advisor performance is the subject. Now, remember what we just talked about.
We did.
How do I measure my financial advisor's performance? I'm with Schwab Wealth Management, and I'm charged 0.56 of the portfolio value.
Pretty cheap.
That's really cheap.
Yeah,
well, depending on the size
cheap.
of the portfolio.
But again, it depends on the level of advice you're getting, too.
Thank you. But
are you just getting portfolio?
This happens on a regular basis. People call me up, and they say, my money's at fill in the blank, and I've only made, 8% a year for the last 10 years.
Here's the thing. I think we're trying to measure by the wrong yardstick or meter stick if we're metric. It's not about what they make you. It's about what they do for you. Because everybody's return should be different, because everybody's portfolio should be personalized. So you can't just compare return to return to return to return, because if I have a very conservative bent and a very conservative portfolio and really little or no need to take risk, I should have a very low returning portfolio, even if I'm paying my advisor 1%, because it's the right portfolio for me. It's the right, and wait, what else are you getting from that advisor?
That's what I was
Did you get a financial plan and ongoing help with planning? Do you get regular rebalancing and hand-holding? Do you get help with creating the income and managing it into retirement? Do you get direction on estate and tax planning and those kinds of things? If you're just getting portfolio management, then you don't want to pay much for that.
No,
but if you're getting money management, pay more. What?
If you're just getting that, right? If you're just getting the portfolio management, what portfolio should they compare it to say this is a good return or not a good return?
You can't. I know this is a cop-out answer, but you can't. I can't say that a 30-year-old's 80-20 portfolio should be at the same level as a 70-year-old's 40-60 portfolio. They're going to be different. So you can't make that simple comparison. I think that's what most of us want to do. We want to be able to say, I want to compare this to this benchmark. Well, there is really no benchmark. It's got to be individualized. So here's the thing. If your portfolio is full of high expense, complex investments, then it's likely to be a more dangerous, more volatile, at times higher yielding, at other times much lower yielding portfolio. If your portfolio is in low cost, match the market kinds of products, that's what you should expect. Here's what you should expect. To match the underlying market. If you're a 40-60 investor and your portfolio is doing somewhere around what the historic average for a 40-60 portfolio is, then you're doing pretty well if you're getting all of those added services.
Yeah, I think that's right. My takeaway always is, number one, every return is idiosyncratic. Don's return is different than mine because money's been invested at different times, et cetera. It's not going to be the same. Number two, what you should know is the portfolio design and why it is. In other words, if it's a 60-40, as you just mentioned, why is it a 60-40? What am I trying to achieve in terms of return? How much risk volatility am I willing to accept? Number three, does the portfolio, this is the part that I think most people overlook. Does it include all the assets that you should own? Most of you own mostly big companies, growth kind of oriented portfolio.
Big U.S. companies. Big U.S. companies.
You do not have U.S. small cap value. You do not have emerging markets. You don't have emerging markets value. There's places that your money should be distributed, and it's not being. That's the part that I would look at from the portfolio when we analyze, when we tell you.
As a matter of fact,
there. Yeah,
I do. Here's another. I can adjust my answer just a smidge. If you are in a portfolio and you've been with that advisor for a very long time, and it has done as well or slightly better than the index of that portfolio, a 60-40, a balanced index, for example, versus a 60-40 managed portfolio. If you're doing as well or better, then your advisor is probably doing what your advisor should be doing.
Yeah. Well, except, again, I'm still going to want to look at those asset classes and make sure they're represented, because there could be periods, by the way, probably like the last 10 years, where certain assets do better than others. So you could look like you're doing really well, and then it wouldn't do very well because you're not properly diversified. So I'd still be
maybe
looking at that.
an even better answer is to look back at what that advisor's portfolio might have done or would have done over the last 50 years.
Yeah, long periods of time. Yeah, I agree. So,
but it's everybody wants an easy benchmark. Is my advisor doing worse or better? No. Is your advisor giving you the services you need? That's what the answer is. Is your advisor giving you the services you need? You can't compare it. It's like saying, is my tax advisor getting me bigger refunds? Every good tax advisor should gift you the exact same refund. Actually, any good tax advisor would try to figure out a way to keep you from getting refunds.
Yeah, exactly. Pay what you owe as you go. I think the bigger issue, frankly, is one you mentioned a couple minutes ago. Whose rocket is bigger? That's what, at the end of the day, you really want to know. Who's got the bigger rocket? And then after that, it's all conversation.
Are you saying size matters?
Just putting it out there. So,
what does that have to do with it? You made that joke unrelated to the current topic.
A real non sequitur there?
It's a redundantly redundant non sequitorial sequitur.
Kind of fits, though, I think.
All right, kind of. Well, with the way your brain works, yeah, kind of total fits. Mm-hmm. Totally fits. Well, look at that. We went way over time today, didn't we?
Yeah, we're
way over time.
Borrowed time, big time.
All right. Once you want to check stuff out, go to talkingrealmoney.com. You want to ask us a question, go to talkingrealmoney.com. You want to meet with one of our advisors for free for nothing with no obligation or no high-pressure sales pitch, go to talkingrealmoney.com. Just go to Talking Real Money. If you're not listening to us the rest of your life, you should be on talkingrealmoney.com. Only two things you should be doing in your life anymore: listening to Talking Real Money or visiting talkingrealmoney.com, because we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.